So today I'm going to discussing about that ratio analysis. So in the ratio analysis, we can see here, today I'm going to be explaining that what are the ratios. Okay. So what are the ratio, what kind of ratios we are going to using, what is the formula for that one simple balance sheet as well as profit and loss account, as well as how they are to extract that information. Like that, I'm going to give the information related to the ratios. Let me begin. So ratio analysis. Ratio analysis is the process of determining and interpreting the numerical relationship based on financial statement. It is the technique of interpretation of financial statements with the help of accounting ratios derived from the balance sheet and the profit loss account. Usually, while preparing that in the management accounting, you can see that in the management accounting, while preparing that a set number of information, here we are trying how we are going to extract the information based on the profit as well as profit and loss account as well as balance sheet account. So classification of ratio, usually we can see that the four classifications are there. First one is liquidity ratio, second one is solvency ratio, third one is activity ratio, and fourth one is profitability ratio. So first one, the liquidity ratios, the measures their firm's ability to meet current obligations. Second one, solvency ratio. These ratios show the proportion of the debt and equity in the financing the firm's assets. Third one, activity ratios. They reflect the firm's efficiency in utilizing the assets. And the fourth one, profitability ratios. These ratios measures overall performance and effectiveness of the firm. So liquidity ratio. So liquidity ratio, these ratios analyze the short-term financial position of a firm and indicate the ability of the firms to meet the short-term commitments and the current liabilities out of the short-term resources as well as current assets. This is also known as solvency ratio. This ratio which indicate the liquidity of the firms are current ratio, liquidity ratio, or quick ratio, or asset test ratio. So current ratio, we can see that meaning here. The current ratio is a vital liquidity ratio which measures the liquidity of positions of the company. Current ratios equals current assets divided by current liabilities. And the current assets are those which items either the cash or be converted into cash in a short term while. Current liabilities are those liabilities which are payable in the year's time. So interpretation like this we can see here. An increase in numerator, the current assets increase in the ratio and vice versa. An increase in the denomination, current liabilities decreases in the same vice versa. A current ratio of 2:1 is considered as the ideal ratio and 1:1 would be to be a tight. It can be used to analyze the financial position of the take corrective action, decide upon the health of the company and take decisions to evaluate whether there will be able to pay dues on time or not, etc. Quick ratio. Quick ratio, it measures the short-term solvency of a business. It's said to be improved version of current ratio. In many aspects, it is also known as acid test ratio. The formulas we can see here. Quick ratio, that is quick or acid test ratio equals quick assets divided by quick liabilities. Quick assets, current assets minus prepaid expenses minus inventories. Quick liabilities equals current liabilities minus bank overdraft, cash, etc. So interpretation we can see here, quick ratio of 1:1 is considered to be an ideal ratio. It is a reliable ratio because assets forming part of a quick assets easily convertible into cash in a short term without shrinking in value. So liquidity ratio, that is the formula is like this: current ratio, current assets divided by current liabilities; quick ratio, liquidity assets divided by current liabilities. Liquidity, a firm's ability to meet its short-term obligations. So solvency, a firm's ability to sustain its activity into a long term. Solvency ratio. Solvency ratios convey an enterprise and its ability to meet its long-term obligation. Debt minus equity ratio equals debt equity. So total assets and debt ratio equals total asset divided by debt. Proprietary ratio equals equity divided by total assets. Solvency ratio. Debt minus equity ratio, debt to capital employed ratio, proprietary ratio, total assets to debt ratio, interest coverage ratio. So debt equity ratio measures the relationship between long-term debt and equity. Normally, it is considered to be safe if debt equity ratio is 2:1. Debt equity ratio, you can see here the formula: long-term debt divided by shareholders' equity and the total debt divided by shareholders' equity. So debt to capital employed ratio is, you can see, debt of capital employed ratio refers to the ratio long-term debt to the total external and internal funds, capital employed or net assets, debt or capital ratio, long-term debt, capital employed or net assets. So capital employed, long-term debt plus shareholders fund. So proprietary ratio expresses the relationship of shareholders fund and net assets, capital employed. Proprietary ratio is equals shareholders fund divided by capital equity. So total assets to debt ratio, this ratio measures the context An extent of the coverage of long-term debts by assets, total assets and debt ratio equals total assets divided by long-term debts. So one simple sum I have given here, problem to solve. The balance sheet as at March 31st, 2015. You can see here particulars as well as rupees. The two main parts are there, the equities and liabilities, and the second part is assets. So equities and liabilities, you can see that here, shareholders fund, under that share capital, reserves and surplus. Second point, non-current liabilities, long-term borrowings, and third point is current liabilities. Second main point is assets, that is non-current assets. Then sub points are fixed assets, non-current investments, and second point is current assets. So these are the simple problems are given here. The interest coverage ratio, it is a ratio which deals with servicing the interest on the loan. It measures the security of interest payable on long-term debts. It expresses the relationship between the profitable for payment of interest amount of interest payable. So problems are given here. The activity ratio, the inventory turnover ratio, investment, net asset turnover ratio, fixed asset turnover ratio, working capital turnover ratio. The formulas are given like this. Inventory turnover ratio equals cost of revenue from operation divided by average inventory. Investment or net asset turnover ratio equals revenue from operation divided by capital employed. Fixed asset turnover ratio equals net revenue from operations divided by net fixed assets. Working capital turnover equals net revenue from operations divided by working capital. So we can see here the net assets turnover ratio, fixed assets turnover ratio, and working capital turnover ratio. This is the format as well as one sum is given. Profitability ratio, we can see here the gross profit ratio, net profit ratio, earnings per share, pricing, then earning ratio. There is a formula that given here. So gross profit ratio as well as net profit ratio, net revenue from operations into 100, earnings per share equals profit after tax divided by shareholders fund into 100, price earning ratio equals market price of a share divided by earning per share. So problems to be solved. This is the problem of us given. So okay, thank you. And